Bitcoin dominance and altcoin dominance are two inversely related metrics that measure the relative market share of Bitcoin versus all other cryptocurrencies. Here is a brief explanation of each. Understanding Bitcoin dominance. Definition: Bitcoin dominance is the percentage of the total cryptocurrency market capitalization that belongs to Bitcoin alone. It shows Bitcoin's relative size and influence in the market. Calculation: It is calculated by dividing Bitcoin's market capitalization by the total market capitalization of all tracked cryptocurrencies and multiplying by 100. Interpretation and use.
Market sentiment indicator. A rising or high Bitcoin dominance often signals market uncertainty as investors flock to the perceived safety of the largest, most established asset. Conversely, a declining dominance can indicate growing investor confidence and a willingness to seek higher returns in other cryptocurrencies. Trading and diversification. Traders use the trend of Bitcoin dominance to inform asset allocation. An increasing trend may suggest focusing on Bitcoin, while a decreasing trend can signal a potential opportunity in altcoins. It also serves as an indicator of market maturity and diversification over time.
Understanding altcoin dominance. Definition: Altcoin dominance is simply the inverse of Bitcoin dominance. It represents the combined market share of all cryptocurrencies other than Bitcoin. Calculation: It is calculated by dividing the total market capitalization of all altcoins by the total crypto market cap. You can also find it by subtracting Bitcoin dominance from 100%. Interpretation and use. Direct inverse. Altcoin dominance moves in the exact opposite direction of Bitcoin dominance. When one rises, the other falls. Altcoin season signal. A sustained uptrend in altcoin dominance is commonly referred to as an altcoin season. This is a period where altcoins collectively outperform Bitcoin, often leading to significant price rallies across the sector. Analysts look for specific patterns, such as Bitcoin dominance breaking a long-term uptrend as a potential precursor to these explosive altcoin periods.
Current context and market dynamics. As of early 2026, market data shows Bitcoin dominance hovering around 59%, with the total cryptocurrency market capitalization exceeding $3.1 trillion. Analysts are observing that Bitcoin dominance is testing a key resistance level. Historically, a failure to break through such resistance has led to capital rotating from Bitcoin into altcoins, triggering major altcoin seasons like those seen in 2017 and 2021. Some analysts suggest the current cycle pattern could point toward a significant altcoin market phase in 2026. Institutional activity is also evolving, with strategies once reserved for Bitcoin, such as complex options trading, now being applied to major altcoins. This adds liquidity and can influence market dynamics.
Based on the analysis of current market trends, a potential decline in Bitcoin dominance BTC.D in 2026 could create a favorable environment for various types of altcoins, but not all will be affected equally. The trends suggest capital would likely rotate from Bitcoin into specific altcoin categories, driven by institutional demand, real-world utility, and new financial products. Here is a breakdown of how different cryptocurrency categories could be affected.
Layer 1 and smart contract platforms. Examples: Ethereum and Solana. Primary driver: institutional adoption and infrastructure.
Regulatory clarity and new financial products like ETFs are bringing significant institutional capital to these major blockchains. Potential impact: high. These are seen as foundational infrastructure. Ethereum is central to decentralized finance, DeFi, and real-world asset tokenization. Solana is noted for its high speed and low cost, making it attractive for tokenized assets and high-frequency applications. DeFi and infrastructure tokens, example Chainlink, Aave, and Uniswap. Primary driver: increased on-chain activity and utility. A thriving altcoin ecosystem with more transactions and value locked directly benefits the protocols that provide lending, trading, data, and other essential services. Potential impact: moderate to high. Their success is directly tied to the usage and total value locked, TVL, on their host blockchains like Ethereum or Solana. An altcoin season typically leads to a surge in DeFi activity. Tokenized real-world assets and stablecoins. Primary driver: bridge to traditional finance, or TradFi. New regulations like the U.S. Genius Act are creating frameworks for tokenizing assets like treasury bonds, real estate, and equities on blockchains. Potential impact: high. Growth sector. This is a major institutional trend for 2026. It represents a new source of capital and use case beyond pure speculation, potentially driving demand for the underlying blockchains that host these assets.
Meme coins and speculative assets. Primary driver is retail investor sentiment and liquidity overflow. These often benefit last in a cycle as excitement and liquidity from early institutional-driven gains spill over into higher-risk assets. Potential impact: high volatility. While they can see explosive gains if a broad altcoin season takes hold, they are also the most vulnerable to sharp downturns and are not driven by fundamentals.
Digital gold contenders, example Litecoin, Bitcoin Cash. Primary driver: niche store of value narratives. They may benefit from a general search for the next Bitcoin, but face intense competition from more functional blockchains. Potential impact: low to moderate. Their value proposition is most similar to Bitcoin's. If the narrative shifts away from pure store of value to blockchain utility, they may underperform other categories.
Key market context for 2026. Importantly, analysts note the anticipated 2026 market dynamics differ from past retail-driven surges. The shift is expected to be more institutional, regulated, and fundamentals-driven. The approval of spot ETFs for assets beyond Bitcoin, like Ethereum and Solana, provides a new steady channel for traditional capital to enter these markets. Furthermore, some analysts argue the classic 4-year cycle may be ending. The predicted 2026 surge is seen not as a short-term speculative bubble, but part of a longer-term structural shift as crypto integrates with traditional finance.
In summary, a drop in Bitcoin dominance is widely expected to benefit altcoins, with Layer 1 platforms, DeFi tokens, and RWA projects positioned to potentially see the most sustained interest due to institutional and utility-based demand. Would you like a deeper analysis of how these trends might affect a specific category like DeFi or tokenized assets?